Hello there. I've had a few requests recently from clients about how to take money out of investment accounts, specifically relating to what if we've got a general account, an ISA and a pension. So I'm just going to run through like a hypothetical example. So we've got a pension, an ISA and a GIA, and we're going to work out which one is the best. So let's say, just to keep the maths simple, we've got 200,000 in each of them. Now, the first thing to think about is, and let's assume that this person has a house that takes up all the nil rate band. So inheritance tax is going to be paid on whatever's not sheltered from inheritance tax. So we don't want to take money out of the pension at all, because pensions, as long as you've got your expression of wishes in place and as long as they're distributed within 2 years of the date of death, do not pay any inheritance tax. They don't form part of the estate for that purpose. So we don't want to take money out of there. The question therefore is, do we take money out of the ISA or do we take money out of the general account? Now, if you take money out of ISAs, it is tax-free. And this is, I think, where a bit of confusion starts to creep in, because ISAs are tax-free not only in taking withdrawals out, but also all the assets within ISAs are completely tax-free. So essentially, portfolios are invested, and what you earn is capital growth, or losses, and losses can be offset against growth and whatever. You get dividends from stocks and shares investments. You get dividends from there, and you get interest from corporate bonds, gilts, etc. You also sometimes might actually get rent if you're invested in what's called a PAIF. And sometimes we do invest in those. So you can get a bit of rent, you can get interest, you can get dividends, you get capital growth. All of these four things are not taxed here. So not taxed. So really what we want to do is make sure that all the money in the ISA, that we maximize the money within the ISA, because the returns that you get are not taxed within the ISA. Okay? They are taxed, however, in the GIA. So taking money out of the GIA, no, hold on. So taking money out of the ISA doesn't improve the tax position of the portfolio as a whole, because this is still paying that tax. So if we're taking money out of ISA and then every year topping it up with money out of the GIA, well, that's not amazingly good. And I'll take you through a couple of worked examples. So let's say somebody was taking, I don't know, let's say £40,000 a year out of their, they want to take 40,000, let's make it a bit more reasonable because I've done 600, let's say £30,000 a year out of their investments, okay? They want to take 5%, they want to take the £30,000 a year, okay? So if we decide to take it out of ISA, so this is scenario one, if we decide to take it out of ISA, at the end of year one, we're not going to put in any investment growth in this, just to, because that would make it a bit complicated. So what's happened is, we've got a GIA, we've got an ISA, right? Year one, what's happened is, from the 200k, we've taken, well actually you've got a flexible ISA. So what we've done is the 200k, 30 grand has come out, so minus 30, we can put 20 into the ISA though, okay? We can put 20 into the ISA from the GIA. So the GIA goes down to 180,000 and the ISA goes down 10,000 to 190,000. Okay, and that happens every year. 20 moves across from here, and essentially 30 comes out, minus 30k, plus 20k. And this happens, sorry, not plus, minus 20k here. And this happens every single year. So year two, we've got 160, and then 180, and then year 3, we end up with 140 and 170, and year 4, we end up with 120 and 160, and then I need to add some Ks, and then year 5, we end up with 100 and 150K, okay? During that time, all the capital growth, dividends, interest and rent that was received this side under scenario 1 is taxed. None of those are taxed here. In terms of the 30K that's come out, that's not taxed, okay? So, scenario 2, what happens if instead we prioritise taking the income out of the GIA and use also the GIA to populate the ISA? So, yeah, G and I. So what happens? Yeah, let's try and maintain the table a little bit. Let's put a line there. So that's year 1, 2, 3, 4, 5. Cool, cool, cool. Right. Oh, then I need a line down there, don't I? So what's happened here is the 200,000, we've taken the 30 out to spend for living costs. And then we've also taken another 20 out to put it into the ISA. So what's happened here is this is now 150K, okay? And every year we're taking out 30K and then we're taking out 20K to put into the ISA. The ISA, on the other hand, at the end of the first year is 220K because every year 20K comes from the GIA and goes in there. So let's follow the maths down. We get 100K here and 240, can't write to 4 or a K it seems. 50K here, and that's now, I don't know why I wrote to 1, 260 there, and then naught of nothing really, and 280K here. You'll see that these figures, because we're not plugging in any returns, are exactly the same. So the total invested here is 280K, total invested there is 280K. Same every single year. You've got 310 here, 310, 340, 340, and then, you know, whatever, because we're assuming no growth. Now, what happens here is, well, let's say the dividend yield in year, I don't know, 1 was something like, we had a good year and it was like 3%, all right? I don't know whether I want to use that example actually. So in terms of like dividends, interest and rent, whatever, let's say that we earned a total of 3% year 1. So that would be 5,400 would be what was earned here on this 180,000. All of that 5,400 is taxed. Whether the 30 grand comes out of here or here, GIA or ISA, it makes absolutely no difference to what happens with the returns in the portfolio. So the portfolio returns themselves are taxed, but they have nothing to do with withdrawals, because every single withdrawal we make, we're effectively making a withdrawal out of capital and then constantly reinvesting in order to build up the capital value. Okay, we're not relying on dividends or interest or taking what you call the natural income because, well, it's unreliable for 2 reasons. 1, it doesn't happen every month. Some companies pay dividends quarterly, some bonds pay twice yearly. You can't get a reliable regular income doing that. And secondly, because of essentially we're in a period of demographic change, more people are retiring, a lot of people are going for income investments. And I don't see companies that are sat there paying heavy dividends because they're fundamentally stagnant. You know, they're good companies that are you know, that have been running for years, but they're not really growing because, you know, they can't really. You know, companies like BP, Shell, Vodafone, pretty well established. All they do is pay out dividends. Those companies, I'm not certain it's a good idea to hold those because from a portfolio perspective, you're investing for the long term and therefore you want growth companies. So actually quite a lot of your returns come from growth. Anyway, I'm getting way too complicated, but but dividend paying companies are not reliable because of the timing of when you get the dividends. They're also not reliable because if a company is a really good dividend payer has a bad year, then you end up with less income and you've got no money to spend on food or heating or whatever, just because one of your significant dividend payers has had a bad year. And I don't really think that's a risk worth taking when you can just take money out, okay? Because if this portfolio were actually returning 5% a year, what would also happen is that 150 would, so that 150 would be greater, that 220 would be greater, and also the 200k that we've got in pension that we're not even touching, that would also be greater. So from an income sustainability perspective, if we get a 5% return based on these four things, and we take 5% out, it's neutral. We've spent our earnings. It's just the mechanics as to how we spend our earnings. How do we do that and maximise tax? And this is how you maximise tax. You take money from the tax exposed. It's important to deplete this as quickly as possible. You will deplete it by either spending it, your tax exposed accounts, your general investment accounts. You'd spend these by taking money out and spending it, or putting money into other accounts. Now, there's another little thing you can do. Everybody's got, even if you've got no relevant UK earnings, as long as you're a relevant UK individual, you can still put 3,600 gross, so that's 2,880 from your GIA to your pension every year. So you can earn 720 quid of tax relief for free. So you get 720 quid for free every year by doing that. But that's just another little thing that that we do. So I hope that's explained why taking money out of the GIA is better than the ISA, because essentially, if we come down to year 4, if this 120k has made some earnings, whatever, and let's say again 4%, let's say 5%, make it sustainable. So 5% of 120,000 is obviously £6,000. That 6,000 is all taxable. Whether the 30k comes out of here or here makes no difference whatsoever. Your £6,000 of return is taxable. If this 160k in the ISA here has made 5%, which is £8,000, that £8,000 is not taxable, regardless of whether the income comes out of here or here. The returns within the portfolio are not taxable. Over on this side, however, 5% of naught is naught, and therefore naught is taxable. Over here, 280,000, 5% of that is, of course, 14,000. So you might have made 14,000 of returns over here, all of which is not taxable because it's in an ISA. And I think as time goes on, we're going to see these taxes increased possibly fairly significantly by a potential incoming Labour government. So I think it's really important that if this is your sort of arrangement, that you get in touch with your financial advisor as soon as possible to make sure that you can get rid of these tax exposed accounts as quickly as possible, either by paying into ISAs or by paying into personal pensions. And there are other things you can do as well. There's VCTs and EISs, but they're a bit weird, and I'm not really going to talk about them too much. But there are other things that you can do to get rid of your tax exposed money as quickly as possible. And realistically, you've probably only got 2 or 3, maybe 4 years to do it before these start to get increased. But anyway, I hope that's been useful, and I hope you have a great day.